about to get a haircut tomorrow. I'm gonna get this taken care of.
Okay, Christian. So we're live, man. How you doing?
Good. How you doing, Steve?
I'm doing good. So we're back, week 2, man. I told you we were gonna do this every week.
All right. Sounds good.
Kind of hit you last minute today, though, right?
It's okay.
All right, cool. So what I really want to talk about today is credit and the value of having good credit to qualify for a mortgage. You know, I had a client call me today, and they were asking me, they were saying like, listen, I want to buy a house. I'm tired of living where I'm living. And I'm sure everybody's been in this situation. You know, they're cramped up in their apartment, COVID, everybody's on top of each other. They need more space. They just got, they were able to save up money. They were able to get some sort of government assistance, and they got a grant or something. And now they have some money and they want to go buy a house. So my first question to them is always, okay, so how's your credit? And they're like, oh, well, you know, specifically today, this woman said, oh, I just checked it on Credit Karma and it was like about 640. And I couldn't help but chuckle when she mentioned Credit Karma. And she looks at it and she's like on the phone with me and she's like, well, why are you laughing? And I'm like, listen, I don't mean to offend you in any way, but Credit Karma is not a valid source of figuring out what your credit is. So instead of me trying to kind of go through it, I kind of figured I'll let you, since you're the expert, I'll let you do it. So tell me, what exactly is a Credit Karma score? And can somebody actually use that to figure out if they qualify for a mortgage?
I mean, it's a great question because it's one that I get literally every day, like multiple times a day. And, you know, I mean, there's, you know, no offense to Credit Karma. I mean, they provide a service, you know, but generally their service is credit monitoring. And it's not necessarily an accurate credit score when you go to a lender and have your credit pulled. Reason being is they don't go back as far. And, you know, we go back 10 years. So we pick up, you know, some things that they're not picking up. The algorithms are similar, but they're not exactly the same. There's multiple different models when it comes to, you know, what is under the umbrella of the FICO score. So in general, you know, we kind of find that Credit Karma scores can be anywhere from 20 to even I've seen as much as 40 points higher than when we pull them.
So basically, so a person can have a 640 credit score on their Credit Karma and then fill out your application, which is super easy, by the way. I'm really glad that you like literally put it in your signature these days. And it'll come back to be possibly like a 600.
Mm-hmm. Yeah, that, you know, and it usually is off, you know, like I've seen it off by a big difference, but, you know, and again, because one thing can throw off that score. If we have, and the reason that we pull all 3 credit bureaus and look at the one in the middle is because some bureaus aren't reporting some of the things that other ones are. Some agencies, some companies or credit collection agencies don't report to all 3 credit bureaus. So you might have Experian picks up something that TransUnion and Equifax don't. You know, so you're not going to have, you know, there's 3 credit bureaus and 3 credit scores, not just the one that they're seeing. So again, it's a great service for credit monitoring. I always tell people, if you see a fluctuation in your Credit Karma score or whatever system you're using, a lot of banks actually will show your credit score now. You know, if you have a credit card with them, it's great for credit monitoring. If you see a fluctuation, you know, it could be fraud. It could have been, you know, a missed payment that you didn't know about. It could be, you know, something significant that you want to look into. But it's not something that we would use for a mortgage.
Interesting. Okay, cool. So that kind of like, that makes a whole lot of sense. So like, if I have Credit Karma and I see that like all of a sudden my score starts dipping tremendously, I should jump in there and see exactly what's going on. So I could use it to monitor, but not necessarily go by the score. The score we could safely say that it could be anywhere from 15 to 40 points off.
Right. You just don't want to depend on the accuracy of the score. And it could, even if the score was exactly the same as we pulled it, just a fluctuation in a credit card balance or something like, you know, like that. Like if I pull somebody's credit last week, I pull it again this week and a credit card reports a different balance, you could see a huge fluctuation in the score just from something like that, you know? So it's not so much that it's inaccurate. It could just be timing also. You know, so there's a lot that goes into it.
Is there a service that you recommend that people use? Is there, instead of Credit Karma, is there something that you use? I mean, without us, you know, going out there and like promoting somebody else's business, but is there something that you would?
I mean, honestly, not one that I would really endorse. You know, I mean, if you're looking for, you know, a mortgage, you would want to go to the lender that, you know, you're going to be working with and have them pull your score, because that's the only one that's going to be used, you know, so, you know, but, you know, but I mean, I would go directly to the bureaus, Equifax, TransUnion, Experian, the bureaus themselves. You know, you could freeze your credit. You know, there's tons of information on their individual websites, the actual bureaus themselves. I would go there.
Aren't you, I heard somewhere that you're entitled to get a free credit report from each of the bureaus once a year. Is that true?
Yeah, that is true. Yeah. Mhm.
So like somebody could really just, once a year, just check their credit and then kind of say, all right, you know what, as long as I'm not going crazy with my spending and I'm paying my bills on time, it should pretty much maintain the same sort of status.
Right.
All right, cool.
Absolutely.
So what do you do? How do you prep people, in regards to their credit? Like when they come to you and they say, okay, Christian, listen, my score is, I thought it was 640. Well, sorry, I thought it was 660, but it's really 620. So like, obviously I'm not, Mr. Homeowner's not buying a house within the next, 30 to 60 days. So how do you, what advice do you give for them to like prep and how do they get their score up?
Well, I mean, the first bit of advice that I would say is don't be afraid to let us look at it, because I can't, diagnose what the situation is. Just like, you go to a mechanic, they got to look under the hood of the car to figure out what's wrong. If I, the first objection that I usually get from somebody is they're asking me to not pull their credit. I'm like, well, how can I help you? Like, this is what I do. I can't, help you with one arm tied behind my
Why?
back.
Because it's going to drop their score, right?
That's the myth that's out there. That's the biggest myth that's out there, right? When you're inquiring, yes, it's a hard pull on your credit. Yes, it takes 1 point off of your score, but we're looking at a range of points from 580 to 850 when you're talking about the different types of mortgages that we can offer. So if you're, and it's usually the people with the highest credit score that are worried the most, because they're the ones, so, if you have an 800 credit score and it goes to a 799, you have nothing to worry about. If you have a 581 credit score and 580 is the lowest you can have, then maybe, you might want to be a little more concerned. But that's the very first bit of advice, is just, if you're speaking to a lender, if you're trying to get to the very first step of the home buying process, don't be afraid, don't be afraid for them to look at your credit, because it's the only way that we can really help you.
Okay, that makes a whole lot of sense. I get that all the time. Oh, they don't want to, I don't need to run my credit. And I'm like, listen, dude, like you got to let them run your credit, man. Like,
Right.
Okay.
Right.
So, all right. So prep for a loan. Number one, don't be afraid to let them run your credit.
Right.
Okay.
Right. And because when it comes to a mortgage, credit is really just opens the door. The income, your expenses, how much money you have for a down payment and closing costs, all of those components have to be there in order for us to get you a loan. So the credit score is really just going to help identify what type of loan we're going to be looking at. But it can always be fixed. So the earlier you start, the better. If you're thinking about buying something 6 months from now, the earlier we look at it, the better. I've had people say like, oh, well, I'm not really looking for 6 months, so why don't you pull it in 6 months? And my answer is always no, let me look at it now, because if there's something on there that needs to come off that you're not aware of, you have time to fix it, boost up your score, and that'll help you get a better interest rate in the end.
Makes sense.
So
Makes sense, because you're able to kind of just tell them like, all right, look, see this card right here, you got to pay this down. And if, correct me if I'm wrong, but like you're supposed to be underneath 33% of your total credit. So if you've got a card with 10 grand on it, you should stay underneath $3,300 of total balance, correct?
Really, you should stay under 10% of a balance.
Really?
So if you have a $10,000 card, you want to keep it under 1,000 for the absolute highest scores. And you actually want to use the credit. You want to use, people that don't use credit have nothing to be scored on. So if you have $3,000, let's say, for example, you have one credit card with a $10,000 limit and a $5,000 balance. That's 50% utilization on that one card. If you had that same $5,000 spread over multiple cards and each percentage of the utilization was under 10%, it would be, your score could be much higher by as much as 40, 60, 80 points, just because of the utilization on multiple cards being under that level. So I always tell people, if you want to use it, but don't go over 10, 30%, you'd still be okay. Once you start going over 30% utilization, the score starts to go down, sometimes dramatically. When you're at 80, 90% or maxed out credit cards, you're doing as much damage to your credit score as if you were at a late payment.
Wow. That's crazy, because like, I'm just thinking about my credit card balances right now. And I'm saying, wow, 10%. All right. And my credit is decent, like I pride myself on paying my bills on time. I'm sure, when you were in college, when I was in college, everybody's giving cards and you're sitting here just kind of running up balances. And then you come out into the real world and it's like, all right, well, that credit score is really a reflection of who you are. When lenders and you walk in to buy a car or whatever, they don't see you as a person. You're not like, oh, well, I've been paying my bills for the last year. Yeah, well, 3 years ago, you were 30, 60, 90 days late on this thing. And that's why it's affecting you right now.
Right. And that is the unfortunate reality of living in like more of a digital world, because everything is, your credit score is so many more things are based on credit score now. It's not just getting a mortgage, it's getting a credit card at a good interest rate. It's getting a car, that with an affordable payment instead of a sky high payment. It's getting insurance. In some cases, it's getting a job. So FICO and credit scores are holding much more weight than they did, even just 10 years ago.
Yeah, that FICO score. And some people don't even they're not even really aware of how important it really is. Like you said, there's a lot of jobs and companies like they're checking your credit. They want to see how reliable you are. If you don't pay your bills on time, what makes them, they're going to hesitate to think you're going to show up to work on time.
Right. And look, it does serve a purpose. If you're asking someone to lend you $500,000, they want to make sure you're going to pay back. It's when you kind of put it in that perspective, but it is very important because it really will help determine the interest rate. With rates at historic lows, you want to be able to take advantage of that. And having the highest possible credit score and mix of a decent down payment will ensure that.
Interesting. All right. So just last question here, because I don't want to take up too much of your time, but dollars and cents, people always relate to green, right? So dollars and cents, having good credit, how much money could it legitimately save somebody when they're trying to get a mortgage, between rates or what's the best way for you to kind of explain that?
Well, if you look at, things from $100,000 loan perspective, right? So, and that's why we're also seeing the housing market doing what it's doing right now. When interest rates are this low, it helps people afford, to borrow more money, take bigger loans, borrow more money, which will drive prices up. So if you compare a rate of 2 3/4 versus 3 3/4, for every $100,000, that's a difference of $55 a month. Now, that doesn't sound like a lot, but that's only a $100,000 mortgage. A $500,000 mortgage, that's a $275 monthly impact.
And the average loan is what, 30 years?
Right. So when you look at it from that perspective,
wow.
270, and that's how far the credit score can range, especially on a conventional loan, based on whether or not you're at an 760 or a 620 credit score.
Hold on a second. Wait. I'm just gonna do this in my head real quick. So let's just call it ballpark, $300 a month. $300 a month, 12 months a year. That's $3,600 a year. $3,600 a year times 30 years. Are we talking over $90,000? It can literally save somebody.
If you have the loan that size, but think about it even just in a smaller scale. Even think about it on a 5 or a 10-year period, how much savings that is. Which is kind of the average life of a mortgage anyway. So it's more significant. Especially in our market where the average loan sizes are higher.
Wow.
So it is, and it's all, and it's all relative to, people's incomes and what they can afford. So, an extra $275 a month, that's a small car payment. That's an extra car.
Wow. Yeah, that's crazy. Okay. All right, dude. Well, I think that's going to wrap it up for today. But I really appreciate your time. And next week, same time, I'm going to give you a call. I'll send you a couple of days before. I'll tell you what we're going to talk about. Hopefully I'll have another interesting client that gives me some sort of question about mortgages, and I'll of course come to the professional.
All right, man. All right, Steve.
All right, Christian. Take care, man.
You got it. Bye.
Later.